We're going to go down a rabbit hole already.
Don't get me wrong. We made a lot of mistakes early on and continue to do that, right? It's not always that you get it right.
And don't worry, we can go on tangents here and there. Side quest is the main quest for this podcast.
The notion that kind of buying junk at a discount is still junk.
Part of our job is to be the optimist.
The whole idea of the secondary fund was going against the grain, right? It sounds obvious, right? But
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Hey Superclusters fans, Abe Finkelstein is back, this time on the soup du jour, Secondaries. With illiquidity at its peak and the average company taking 10 to 12 years to go public, as opposed to 7 to 9 years, with funds becoming 15-year funds, as opposed to the 10 plus 2-year funds. For the uninitiated, that's the 10-year fund term with the optional 2-year extension at the GP's discretion. Liquidity is on everyone's mind. And so for those of you who haven't checked out Season 2, Episode 1, I highly recommend that rabbit hole when we talk about how Vintage invests in fund managers through their fund-to-funds Type 1 and Type 2 errors when evaluating GPs and more. And while this is the follow-up episode to his first, this is a standalone episode. So, a quick background on Abe. Abe Finkelstein is the co-managing partner at Vintage Investment Partners, one of the best in the business on 3 fronts: secondaries, fund-to-funds, and growth. He cut his teeth in public equities at Goldman Sachs, among many other institutions. The man is a legend, a Baltimore boy, but now spending most of his time in Israel, where he's calling in right now. So without further ado, Abe, welcome to the show, my friend.
Feels like it too. Good to be back, David, and congratulations on all the success with the podcast.
Oh, it's been so fun. I've that saying where people are like, what is work? Oh, what is play to you but work to everyone else?
Yeah.
This feels like that.
There you go.
So, I've been playing for the last year and some change, probably coming up on 2 years at this point. But I've been playing a lot.
Amazing.
In fact, I don't think anyone can see this because we're recording this on Riverside, but we can add in titles and also you just have Abe Finkelstein as your kind of name. You can see my side. It says David, and then you'll see that title I put in. I've kept it in since the last couple of episodes because that's what I get to do.
Nice, asking dumb questions. I love getting dumb questions, but I think most of your questions are pretty good. So I think you're selling.
Hopefully, you won't get offended. You're like, David is so dumb. Why did I agree to be on this podcast?
Not at all. Asking great questions.
I appreciate it. So maybe to start somewhere, because we have the last episode you were a part of, Season 2, Episode 1, which feels like a long time ago, but people can tune into that to see the beginnings of Abe. But for this conversation, why don't we start with your first investment? How much of your first check has changed the way you think about capital allocation today versus then?
It's interesting. I mean, first of all, it's going back now a little bit over 21 years, so you gotta forgive me that I don't remember all the
2003.
details. Yeah, right, exactly, 2003. What I would say is, again, looking back, just as a reminder, when Vintage started, our first fund was a secondary fund, so it was buying out investments in venture capital funds, buying limited partners out of venture capital funds, and then also, even back then, which was kind of novel, and we probably touched on that a little bit last time, as you recall, we were doing direct secondaries as well. So if I had to think back, kind of those first investments, I'd say there's 2 learnings here, because let me talk about the first few of them. One was that they were mostly buying LPs out of venture funds. So we were buying a slug in a venture fund that had exposure to a bunch of companies. Sometimes these venture capital funds were fully funded, or sometimes they were funded maybe 60 or 70%. But by and large, you knew what the whole portfolio was. And I would say is in some cases, we were getting very deep discounts on certain deals that had what I would call maybe semi-interesting portfolios. And one of the things that resonated me with early on when we saw it, we kind of came up with the notion that kind of buying junk at a discount is still junk. So, I get asked a lot doing secondary deals, what discounts are you paying? What discounts? And clearly, we want to pay discounts when we get in at discounts when we do deals. But ultimately, it's really about the underlying portfolios. So some of the stuff that we were buying at these amazing discounts turned out to be junk regardless. And that's kind of stuck, obviously, with me throughout the last 21 years and probably will with the 21 years going forward, hopefully. And then in some other cases where maybe the discount wasn't quite as deep, but you had more interesting assets in the portfolio, or maybe there was more diversification, for example. They actually turned out to be, when I think back again to the first couple of deals we did, that was really the driver. So in some cases, the deep discount deals weren't the best deals. It was actually the ones where maybe the discounts were more modest, but the quality of the underlying assets were more attractive. Again, that certainly from those first initial deals have stuck with me throughout the entire time we've been doing secondary transactions, which is obviously from back in 2003 until today.
I have two questions, one on discounts and then the other on, you said, the quality of the underlying portfolio. So let's start with the quality first.
Sure.
I'm curious for you, how are you assessing? What does quality mean? Like let's start with 2003. What did quality mean back in 2003?
Yeah, no, it's a great question. I mean, look, I still think at the end of the day, a lot of it is still the same until today. So I wouldn't say there's necessarily a big difference between quality in 2003 and today. I think a lot of it was around, for sure, understanding the underlying companies in the portfolio. We spent a lot of time, not just interacting with the GPs. We would go down to the company level and talk and meet with as many of the CEOs and founders as possible. So it was, really myself and Alan at the time. And then over time, that's been a part of everything that we do, is really speaking to the companies and us having an opinion on the underlying founders and see if these are founders who want to go and build big businesses. Now, some of them do, some of them don't, some of them will, some of them won't. But it's really understanding that first and foremost. And then it's digging into the business. Like, we definitely isolate who we think the value drivers are, even when we're buying an LP out of a fund, and then understanding those value drivers. Are these large markets that they're going after? It's all the classic kind of VC analysis. So again, it's not just, okay, there's 10 companies in the portfolio and they're valued at X, and let's buy them at a 40 or 50% discount and everything will work itself out. So we want to see that quality in the portfolio. And then there's quality in the portfolio also means portfolio construction. So, are there solid holding percentages and capital in the key value drivers? Is there capital still to invest in these companies? I mean, we spend a lot of time looking at that because in many cases, maybe this was, we saw it a little bit over the past couple of years, and who knows where the market's going to go today. But back in 2003, it was so uncertain. A lot of funds were getting washed out in their companies. There were down rounds happening. Again, we've been seeing that more and more over the past couple of years as well. And you have to also understand, is the overall portfolio and fund quality enough to get through that? And is there enough capital to support the quality companies? And is that where the managers, are they going to put their money into those companies going forward? So we look at the underlying companies to see if the portfolio is quality. We talk to the GPs to see if what they plan to do with the money fit with what we saw as the quality company. So it was really doing this 360 assessment in order to understand how much we want to pay for that particular asset. And again, sometimes we say, okay, we don't totally agree with where they want to put the money, and maybe the companies aren't of quality, so let's just put a deeper discount on it. And 9 times out of 10, those deals just didn't work out. So we really try to avoid, doing those deals regardless at whatever discount, where we felt those things didn't align. Quality companies with managers who were going to support, had the reserves to support, and were going to support the companies that we thought were quality in the portfolio after having met them.
When you talk about, let's say, is there more capital to be invested in these companies?
Yep.
Do you largely mean the reserves for a manager, or do you mean, is there capital in the ecosystem to fund these companies?
Yeah, no. So it's great. What specifically I'm talking about is, like, if you go into a fund and let's say it's 100% called, and they have a bunch of companies that are still relatively early stage, that maybe these will be companies that need to raise a lot of capital going forward. You need to take into account that fund is at risk of getting heavily diluted or even washed out in some cases of companies. As we know, not every company goes straight up and to the right. So there's going to be ups and downs, and you need the capital to protect it. So I was more referring to that, but you make a good point. I mean, we do, when we do secondary deals and looking at companies and portfolios, we also do an assessment around like, okay, who are the investors in the company, and are there deep pockets enough around the company and within sectors that could be interesting. In fact, when I look at most of the secondary deals that we're doing, they're typically either in funds or with companies where we have a pretty close or trusted relationship with at least one, if not more, investors around the table. So it's definitely not at the level only of, the fund. Do they have reserves to keep backing their winners and protect their winners? But also, are these companies that can raise capital, in the current environment from quality investors and have investors with deep pockets around the table? So it's a big part of the assessment. I kind of distill it back down into it's not, and again, it might, there might be others who look at it differently. It's not just simply, okay, I'm buying this cheap, so, this should all work out. You really have to know a lot of who the investors are, what you're buying, where it is in the stack, is there money to protect these investments, and so on and so forth. So again, at least that's how we approach it.
Okay, so we're going to go down a rabbit hole already. This is going to be my junior varsity question for today. Actually, this is going to be one of my many junior varsity questions for today.
Sure.
Like, how did you have the prescience to know that a company was going to get funded? So hypothetically, let's say there was capital lying around to fund a company, but this is 2003. Search engines were not really a thing yet. Social media was not a thing yet. There was a lot of things that were created during that era that ended up becoming transformative of what we know today.
Yep.
How did you know that as people were pulling back from the market, these markets were still going to get and receive the capital, even if there was capital?
Yeah, no, it's a great question. And by the way, like, don't get me wrong, we made a lot of mistakes early on and continue to do that. Right? It's not always that you get it right. What you want, obviously, is to get it more right, and something much more right that than to get it wrong. And definitely, a lot of it was around understanding the motivations of the founders of the companies. Again, did they want to build big businesses? Did they not? Looking at who was already around the table, talking to the various funds, getting their input of which companies they wanted to back and which ones maybe they wouldn't want to back. So it's really doing that 360 work. And again, you can't always do it on every single company, and you might get it wrong, and you might get it wrong and not get it right. But that it's definitely just about doing the due diligence. And in some cases, I would say, whether it's going back, a decade ago, maybe avoiding sectors like, clean tech at the time, or even going back, way, way farther. I mean, you mentioned, search engines and stuff like that, but, definitely making a call about what sector might be interesting or not. But it was more around, like I said, if I kind of distill it down, as we talked about in the past, like going down to the company level. It could be a great founder and a great company who doesn't have great investors around the table, and we'd have to, think twice about that. And we made a lot of mistakes around that, and have a lot of learnings around that. But if you really want to look for that combination, and then when we do the deals, we're putting value on those companies, and then we can underwrite, our returns that we want to see by putting value on those companies, then usually that works out. I would also say is that, it always helps, and I mentioned it briefly before, is that, buying a portfolio, for example, that's diversified, that has relatively decent holding percentages in companies relative to, the size of whatever you're trying to do, also helps. It just means there's a lot of option value. We've definitely had cases where there have been companies that we put little to no value on, but you know how it goes. Like suddenly that can become a big winner in the portfolio as well. So having that option value where it's completely unknown, but it's showing some signs. Again, it might be we like the entrepreneur and we like the investors, but we're not sure about the sector. But having enough of that has also kind of saved, I would say, a bunch of deals that we've done over the years. And we definitely take that into account more and more often when looking at new deals. But again, a lot of it is guesswork and art. But I do think the due diligence, if you do enough of it, you can definitely hone in on the ones that can be successful, and the ingredients to be successful.
I'm curious for you, when you're talking to the founders, and I do have another question on the founders as well, but like when you're
Sure.
talking to the founders, let's say they're valued at $50 million at that point
Sure.
in time.
Okay.
We're not trying to do math here, so don't remember
Yeah.
these numbers, but
Right.
like,
A little bit later
so
in the day for me, so
I know it's early in the day for me, so I can still do math, but I'm also like, I'm a kid compared to this. I haven't reached my like drinking age in my
Yeah,
career yet. So
for sure.
um all that to say is when you're talking to a founder and let's say they're valued at $50 million, what is the underwriting or the rough underwriting in your head? Do you think if they go through like, is this going to be a $300 million outcome? Is this going to be a
Yeah.
$500 million outcome? And does that justify, let's say, a 6 or 10x in that? Does that justify our investment currently? Or
Yeah.
are there other things when you're talking about the size of the vision, so to speak?
Yeah. Look, it's interesting now, kind of thinking a little bit more about when I think back to kind of 2003, 2004. We were definitely thinking that M&A was probably the outcome for the vast majority of the companies, so they would be bought on a strategic basis. So, and again, back then, a $50 million valuation actually meant something, right? Like, no offense to anybody, but that kind of happens really quickly these days that they get up to those levels. But if I think about it, going back then, a business that already started selling, had some signs of product market fit, we would really try to do an assessment of, again, the ambitions of the founder and then the market size, and that they have the right people around the table that were also as ambitious. For example, do they have funds already invested that a $300 million exit wouldn't be meaningful for them? Then and we saw the right ingredients to say, okay, maybe we'd feel more comfortable that this can be bigger if all the other signs align. But those relatively early stage companies, at least what we're doing, we're rarely putting significant exits on those. It could be anywhere from 0 to kind of $300 million, like you said, and we tend not to kind of earmark whatever the last round value was in a company. Obviously, there are investors that we respect more than others in their judgment, on what valuations are for companies. So, and it could be that looks like a very, very high valuation for a very early stage companies, but we do respect very highly the investors around the table. But I would just say rarely at those early stage companies are we putting higher values than what you talked about, which is why, for example, if we're buying a portfolio, if we're buying, an LP out of a portfolio or doing a secondary direct, we tend to move it, on the later stage. So meaning in a portfolio, I'd want to see at least a couple, later stage companies that are selling probably tens of millions of dollars that I can hang my hat on or anchor around, and then kind of fill in the rest with exits between 0 and kind of 300 million that you're talking about. So, that's kind of how we look at it. And again, the $50 million valuation companies or those early stage companies, we rarely put meaningful value on those. It shouldn't be the driver of a deal for us, is the way I put it, because then ultimately we have more of the profile of a venture fund. It's almost the way I would say, versus a secondary fund.
So in many ways, you're probably looking at, all right, this is instead of a $50 million value, I'm making all these numbers up, by the way.
Yeah.
It's more like they're at $5 million in annual recurring revenue. They're doubling every year. That seems like a good quality of the business. They're probably going to continue growing. If the exit outcome is an M&A at, let's say, $200, $300 million, are there market comparables where companies are acquiring companies in that industry for that number? And then on top of that, for the existing venture funds that are already invested in this, let's say $50 million company in this example, is a $300 million exit meaningful to their fund? And if they're a $150 million fund, that's a 2x on their fund, it might be meaningful. It might not be meaningful depending on what their ambitions are as well.
That could be pretty meaningful for that fund, but yes.
Okay. So to be fair, I wasn't working in 2003, so I'm guesstimating these numbers based on historical numbers. But do help me.
You're pretty much in line. Yeah, I was going to say you're hired. So if
amazing. This was my interview. This was my interview.
Right, exactly. Now you get kind of how we look at. By the way, that plays a big role in it too. When we think about doing secondary LP interest and buying into a fund, we're looking at at what exit. By the way, the secondary market today is obviously much more mature than it was back when we started. So you often see the earlier funds, in some cases, even selling off right into later rounds, which didn't happen 20 years ago or even
Oh yeah.
15 years ago. So we have to take into account, wait a second, I'm buying this LP interest, and I might think this is a $1 billion outcome, but maybe the VC is going to sell it for 300 million. So there's a lot more you got to take into account, when simply buying LP interest and just again looking at the company. It starts with saying, okay, is this a great company, and where do we think it can exit at? But then, how does that fit into what the fund looks like? And again, I mentioned reserves earlier, size, where they are in their life. It's all those things. So you got to take a look at. But for sure, going back to the original question, I thought like when we're doing these secondary deals, we want to see something. If something's selling $5 million, doubling whatever year, it sounds like a great company. We could get more aggressive with the exit valuation, but probably not that much more aggressive. It would have to be something that tens of millions of dollars, dare I say, even a few hundred millions of dollars. Again, that we want to see kind of anchoring a deal that we think has IPO potential or clear IPO potential in order to make the deal, to de-risk it enough and then make it attractive enough for us. Which is why, by the way, like when I think about how most of our deals get done, not to kind of jump around, but most of it is we're again working with our trusted partners and funds and getting the deals from our GPs in some cases, and reaching out to LPs as opposed to kind of getting caught up in all of the auctions and the hype and things like that. Because you'll see a lot of groups just pay very, very high prices for things that are very close to what they think will be the IPO, for example, which unfortunately now, given the way everything's going, all that's kind of been delayed. But I think, given the way we've thought about pricing, that's kind of, at least for now, has kept us in good stead, whether the exit markets are open or not.
Before we get into today, I have a couple more questions of yesterday.
Sure.
And don't worry, like we can go on tangents here and there. Like side quest is the main quest for this podcast.
Yeah, sure.
You mentioned something earlier, which is about like the concentration, the ownership that a fund has in a company. I imagine like if they own 1% of the company, that's not nearly as meaningful. Like, is there a threshold, let's say at that point in time, that was meaningful enough for you to take a double look at?
Yeah, I mean, some of it is relative to it's interesting. Some of it is relative to the fund size.
Okay.
So I was going to say, if I have a $10 million fund and I own 1% a whole bunch of companies, and maybe that's not bad, right? If these are going to be massive outcomes. The risk with owning so little in your companies is that, again, when there's ups and downs and, you really don't have much say or any control. But it's more about that. But for sure, again, like if you own, take the top 5 companies out there today, private companies, and you own 1% of them on a small fund, that's great. And then it's more relative to how much it can return of your total fund. If you have a, $500 million fund and you have low single digit holding percentage in all the companies, it's going to be a bit more challenging. Just again, not to throw math in there again. So I wouldn't say there's a specific threshold. It's kind of more related to, I don't know, if you take $100 million and say, okay, it's probably for every $100 million, you want to have, again, there's a cap on it, but you want to see like at least 5% or something like that. But that's kind of in general. Again, it's if there's an amazing company, if somebody has a smaller fund, 100 million, and they own 2% in Databricks. Again, not trying to do the math. You're right. That's not bad as well. So
there are always exceptions, but you can't build a model around exceptions, if that makes sense.
Yeah, no, that's exactly it. I mean, it's interesting. Like even today, we were looking at a deal, and one was, they're all so different. It's so interesting. Like, so we're buying an LP interest out of a fund that has 2 very late stage companies and a bunch of other earlier ones that are other ones that we don't think will necessarily result in anything. So it's really like, okay, how do we think about these 2 late stage companies? Each of them were valuing in, $1 billion or more, and that's 80%, 90% of the returns. In a fund that's pretty far along, was doing growth stage investments. Again, it's buying an LP out of that fund. And then we looked at another fund, which was called 100%, but was investing in very, deep tech, science related ideas, with a few that looked like they're breaking out, and but nothing that you can necessarily hang your hat on as being some massive outcome because the companies hadn't scaled, or maybe one of the companies had scaled. And again, we would just look at it just very differently in terms of, again, how much capital. And again, the two other companies, by the way, in the prior fund, again, not to throw too much, they don't need more funding, for example. So you eliminate that risk. So we just look at it in very, very different ways. One will have to see higher multiples and higher IRR on, and therefore probably a deeper discount, although again, that's a whole nother conversation, versus another one where we feel more comfortable, underwriting to a lower multiple. And again, we think there'll be exits more in the near term. One then is also more diversified, where the other one is more concentrated. So again, there's a lot to take into account when looking at the different deals.
I'd love to take a brief respite from our math lesson.
Thanks.
And I want to, one of the questions I have. So you guys started in 2003, and let me correct me if I'm wrong here. I believe it was a $64 million secondaries fund.
That's exactly it. Yeah.
The whole name of the game, it sounds like, was you spent a lot of time with founders. You spent a lot of time talking to founders. Question for you: How did you and Alan build a founder network? Why did founders take your call in the first place?
No, look, first of all, it's a great question. A lot of it was timing, right? This was 2000, like you said, you're going back in history, 2003, 2004, 2005. People weren't necessarily falling over themselves to invest and talk to companies. We had our own networks from prior careers. Alan as a VC and as an investment banker, myself on the public equity side. But it really was again a time when I think if you were knocking on any entrepreneur's door, they were interested in listening because nobody knew where their next dollar would come from. So that's really how it all started. So it was good timing around that. And I would say it sort of started, we were always trying to figure out ways of adding value to the companies even back then. Again, we talked about it, we formalized that, and that's really how we're able to do it today, is really always thinking about how much value, what's the value that we can add to the entrepreneurs. We were doing it back then as well. We were always thinking about other customers they might want to speak with, other downstream funds who might be interested in investing in the company. But and then it was just a lot of knocking on doors and hard work. I also would say, a lot of it started, again, we were mostly in the beginning doing these LP interests out of funds. We would talk to the GP, and the GP had somebody who might default or wanted to sell. They probably wanted to do it quickly and quietly. And we would tell the GP, look, in order to do this, we need to meet companies in the portfolio. So they were open to doing that with us at the time. When the markets are, very down or crashing, or can't tell what the future is going to be, or it's looking bad, then people are much more open to being accommodating, is the way I would put it. Since then, again, we've had just to think about ways that we can keep adding value to the companies in order to get that and to the funds in order to get those doors open. But that's how it was back then. It really was like a desert back then.
Yeah. And when you were asking a GP for hey, we need to talk to your companies, did they introduce you to every company? Did you only talk to 50% of the companies? What did that look like?
No, it's a good. So in the beginning, I have to say it was nearly all the companies. And again, most of the portfolios just is usually there was probably 20 to 25 companies, but that's what we did. We just went around to, and it was good that we did it also because we always kind of check ourselves and look back. And in this way, we had a large enough pool of companies that we had met and had assessed to see how we were doing and if we were assessing the right things or not. Like I talked about putting, even more emphasis on the founders. There were certain sectors where we didn't do quite as well in, like the medical sector, where we got so enamored with everything and put, amazing exit values on those and learned our lesson the hard way around that. But in the beginning, it was, if it wasn't all of them, it was nearly all of them. A lot of it also was because the portfolios were still pretty early stage at the time. It took longer for companies to ramp back then. So we really wanted to make sure that we understood what was going on, in the companies. And we did a lot of work around the markets and the competition and things like that, the potential buyers of the company. Again, it was very M&A focused, which was also a big change in our philosophy over time to really put value on those that we think can be, very large exits and typically IPOs, even if they might end up being M&As. But it was a lot. Maybe one day I'll pull out some of the books that we used to write on every fund. Now we're putting in PowerPoint and other things, but we literally would write a book on every single fund and kind of pre-process the fund as much as possible. Do one deal and then do multiple deals and so on and so forth. But long story short, yeah, it was most of them. It was a lot of work.
I'm curious for these. This is going to scratch my own itch here. But for the books in which you guys had, was it like one fund per book? Was it multiple funds per book? Like, what was the logistical layout of these books?
So it was often one fund per book. Occasionally it was like a deal per book, but within that, each section was a fund, and it would kind of give the overview of the fund, much the way we do it today. But then it was literally 3 pages on every single company. I mean, like as looking back, some of it might have been a little overkill, to be frank, but I'm glad we made the investment because, again, it gave us enough information to look back on and say, hey, did we assess this correctly? Did we not? I talked about the offsites that we do, 3 times a year going offsite and kind of beating the crap out of ourselves. But yeah, that's what it was like. It was the deal overview, the merits, concerns, the sensitivity analysis, and then pages on every single company. And again, we kind of do something similar today in a different format, but we more focused on what we really believe will be the key value drivers. I think the big mistake we made back then, and occasionally fall into today, is that we put value on more companies probably than will actually exit, right? So, and we have discussions around this a lot. At the end of the day, there's a finite number of transactions every year, whether they're M&As and even more rare IPOs. But I do believe if you kind of count up in our models where we actually place value, it's far higher than the number of companies that can actually exit. So we've been trying to get better around that as well.
I mean, part of our job, correct me if I'm wrong here, is to be the optimist when all things aren't going well, especially in a bad market where it's so easy to be like, that company's going to die. It's so easy to be a naysayer. It's so easy to complain. Like, part of our job is to be the optimist and say that, yeah, there's a light at the end of the tunnel.
100%. And again, I do think, part of if I go back again to the original raise of the first fund, and it was Alan who did it, and I was along for the rise and the ride and the raise and the ride. And then, the whole idea of the secondary fund was going against the grain, right? It sounds obvious, right? But the dot-com bubble burst. Everybody wanted out of tech. Everybody wanted out of VC. It should have been the most obvious investment to go, hey, let's go in and buy this stuff on the cheap if you believe in technology. And some people did and backed us. But the vast majority of investors said no. I mean, to be fair, it was a first-time fund doing the strategy, but that's exactly it. Like, the whole birth of vintage is saying, okay, you got to be optimistic and contrarian, basically. So that's for sure. Sometimes, again, it can lead you to putting too much value on too many companies, which we're always trying to, check ourselves about and saying, hey, what are the real ones here that are going to end up being big exits, and what are the real ones here that can actually exit and why? And that's what we spend a lot of time focusing on when we look at the various models and the deals that we do.
What was the consensus then? Because it feels like to me that, as you mentioned, like, if everyone's trying to exit their companies because the stock market's crashing and all that kind of stuff, it feels like secondaries would be the natural kind of angel that swoops in for everyone.
Yep.
Why weren't people interested in secondaries?
Look, I think just and it's kind of what happened in 2008 as well. It was just a hangover from the bubble, right? Whenever there's some big bubble in something and then it gets burst, there's a hangover. And I think people, whether it was because all these companies had crazy inflated values in the public market, everything was based on eyeballs and things like that. I think people really doubted technology and the longevity of technology and venture capital in general. And again, I want to be fair that it was a first-time fund, and you have to convince people. And Alan did an amazing job doing that, and probably one of the hardest times ever to raise a fund.
Yeah.
Me seeing it from the sidelines gives me sympathy for all the new managers out there raising funds. So I try to be as open-minded and helpful and all that. But I think just at the time, it was basically that people were just burnt completely by technology investing in venture capital. I remember also after 2008, there was a really strong investor who had invested with us, who I met, and after the real estate bubble burst, everything, he's basically like, I'm out of the market because I don't see any growth drivers for the next decade. Like, what's it going to be? And what it ended up being technology again. And if you had gotten out of the market then versus getting into the market, then you missed this amazing run up. So again, I think it's just people, get scared when this stuff happens. I'm kind of optimistic around given everything again, like we want to go back versus forward, but everything that's going in the market today, I actually feel like people aren't quite yet overreacting to it, because they realize there's these ups and downs, but we'll have to see. Hopefully, the current situation also doesn't get people too freaked out, because again, these are the times that you want to be investing, right? It's just people don't think that way. They see the blood on the streets and they run from it versus going in.
I'm gonna go back and ask another selfish question, which was, you used to have these books, these physical books that you had per fund per deal.
Yep.
Logistically, how did you move these to the cloud, or did you ever move these to the cloud in terms of information storage and succession?
100%. I mean, we definitely. The one thing I haven't done is I should do this at some point is take all those books and like throw them into GPT or something to see what what recommendations comes out. But yeah, no doubt. I mean, it's been a process, but we definitely we're big believers in data from day one, which is why again we would try to meet as many companies as we could meet. We would ask them a whole variety of questions. Again, even around who they felt their best investors were, what their asks were, not just necessarily about the business. We just thought this was important data. Asking them about why they struggled raising capital or why they didn't, what have you. So a lot of it was Excel and Word and physical books, but over time, again, it's a constant process, but all that gets migrated to the cloud, to new systems. We're developing our own tools, for example, as well. I think a lot of funds are starting to do that, which is extremely important. But for us, the core was always that information and that data, and then now it's about whether you access it. Obviously, not through a printed, hard copy book, so to speak, but doing it through the cloud and doing it through other systems. And now, hopefully, again with AI, I was kind of being facetious around putting all that information, but it's definitely something that I'm thinking about, and we want to do more of. Taking all the information that we put into these various presentations, various Excels, and seeing if there's things that we can extrapolate from that using technology. And we're starting to do that actually. So
yeah, the collective vintage brain.
Exactly, and at some point, so they'll be able to get rid of me too. But
I don't think so. There is still a lot that GPT needs to learn.
And again, it's not. I think more so the way I look at it now is just more. It's most helpful around efficiency and organizing everything and accessing the information more than anything else.
You talked about discounts and assigning discounts, and one of the things I love that you said earlier, and I'm going to paraphrase this because I don't remember the exact verbiage you used, which is like, you can't if you put a discount on junk, it's still junk.
Yep.
Right?
Yep.
How did you assign discounts to good companies?
Yep. That's great. I mean, on a basic level, I mean, when we're looking at the companies, we're basically modeling them out as much as possible with the information that we have to figure out what we think the various exit ranges can be, and the timing on those exits. Again, how much more capital they're going to need to raise in order to get there, and how that impacts what we're buying today and the holding percentage. And then we kind of work backwards again to what we need to underwrite to in order to assign a discount. But I'll give you a great example. Like, again, I'm not talking specific funds or specific companies, but we had a an LP interest in a fund that we bought probably might be about like 9 months ago. And one of the key anchor companies I talked about was being held by this fund at around $14 billion, which is not, that's a big number, right? It's an amazing company, $14 billion. And then there were other funds that were holding it at, I don't know, 50% more, even 100% more than that based on transactions that had happened in the company. So if you think about it, like if I'm buying out of this fund that's holding it at $14 billion and I have my price that I want to buy it at versus a fund that's holding it $20 billion, obviously the discount I can pay for the fund that's holding it $11 billion, all things being equal, is going to be much less. So in this case, we did a deal in that fund. I believe it was, and again, this was the anchor company. It was a big part of the returns for around a 20 to 25% discount.
Okay.
But if it was in that fund that was holding it at 20 billion, that same discount would look like 40 or 50. So we also spend a lot of time like doing, again, if my math's probably wrong, but so you get the
Directionally there, yes.
But I was, what we've done a lot is really, when we think about what we're targeting for secondaries is great companies. And then we're looking, how can we get exposure to them at the best price? And it might be, and a deal that will most likely close. So this is a great company. I may not be able to buy it at a 50 to 6% discount, but maybe there's a good chance I can buy it at 25, and it just has to do with where the funds hold them. So one of the things that we're doing with our database is exactly that, is that all the data from all the funds that we have exposure to, that we get information on, goes into the database, and we literally can look across the funds and see which funds are holding them at lower values, and therefore talk to those GPs more or target LPs more about buying out of that fund versus the other fund. So that's, again, but ultimately the discount is based on what we're underwriting to and where we think that company can exit and when, because we're looking at both multiples and IRRs on the deals.
What percent of secondary deals that you do either today or yesterday would you say comes from like proactive outreach of like, oh, we want to own this company, but we need to find a fund that has this company or a meaningful ownership in this company? And how much of it is reactive, where let's say an LP wants to sell a stake in the fund?
Most of it is proactive. I would just say, again, it's all nuanced. So again, we're doing the secondary LP interests, we're doing the secondary directs as well. So buying shares directly out of a company. So we're constantly, for example, like whenever I have conversations with our GPs, we're always reminding them we do secondary deals, right? We also do growth deals in companies. So we're telling you, if you have an LP, where the address that might want to sell. If you have secondary deals in your companies, for whatever reason, where the address. If there's a growth round, that's another story. We don't where the address. So all those things. So and then 6 months later, the GP will say, "Hey, Abe, we were talking. I have this deal." So to me, again, that's the proactive work that we're doing.
Yeah.
Always talking to the GPs, and the same thing. There is obviously a very mature and probably semi-systematized, I call it, market for secondary directs, particularly in later stage companies, and many of the names that everybody in venture capital and even outside of venture capital may know. What we do there is we're gauging the market, and we're always getting inbound from various different agents and groups that say these are the lists of pricing that we have on these later stage companies that are the well-known names. We're putting that also into our database so we can see, where the lowest prices are. And then we build models on the underlying companies that'll say, okay, on this company, I'm willing to pay a 40% discount to their last round or what have you. And then suddenly I'll get a flag saying, okay, wait a second, we just got a deal from an agent in his list that said, here's the company, and they're willing to sell it at a 40% discount. And that matches what our pricing is. So again, that's incoming from the agents them sending lists, but for us, it's us saying we want to be in that company at this price, and suddenly there's a match in the market, so to speak. And then of course there's stuff that comes down the pipe where we're LPs, they know us, they'll reach out to us. And then also in cases there's often auction deals that are led by some of the larger banks and things like that in the industry. Typically, we almost never win any of those because they're very competitive. A lot of larger funds are in those. What I would say is there are certain niches that we work in, whether it's investing in European venture funds or investing in Israeli venture funds, investing in small venture funds, where they might have a very large package of funds, and occasionally, because of our speciality, we can carve those out. And it might be something that maybe somebody else is less interested in or doesn't know quite as well. And then there are other cases in those where, because we might be where the GP in some cases will only approve certain potential buyers. We have very close relationships with certain funds where we may be only one of two or three approved buyers as well. But the vast majority of deals are us just being out there and saying, hey, here's what we do. We want to be helpful if you have a situation where somebody might need liquidity. Otherwise we wouldn't get the deals. At least we wouldn't get the attractive deals that we're trying to get. You have to be very proactive in the market.
How do you stay top of mind for LPs and GPs? I know you have a great annual summit, which I was lucky to have been to. Not the last one, but the one before that, where we also met in person.
Yep.
What else do you do to stay top of mind?
Yeah, I mean, it's just it's a constant grind in a good way. I mean, it's just literally like always talking to your customers, right? It's always talking to our funds and reminding them. Luckily, we're not in. We'll do deals and funds that we're not invested in. But if I could do all the deals of the funds that we're invested in, that would be the ideal situation. So, again, they have their day and night job, so we're not always top of mind, and that's fair. But whenever we have the dialogues with them, and again, we have a very large team. I mean, we're 70 people, so and that goes throughout the firm, whether it's people on our data side or the people at the Value Plus side, or even finance. Sometimes they'll talk to the CFOs of the funds and the companies. We're constantly reminding them that we do these types of deals. We write blogs. We write, it's always in there somewhere.
Great blogs, by the way.
Appreciate it. None that I've written, it's others. So it's great. That's what we're spreading the responsibility. But so I agree. But it's really about that and getting out there and doing things. Educating people about the secondary market, educating people how we work. And do it differently. Again, I think I may have mentioned last time, one of the things I'm proud of is that, we've never signed an LOI, even if it's non-binding, that we've backed out of, because we're constantly processing and doing the due diligence and things like that. So it's really about making sure our reputation remains platinum, with our GPs and the companies around secondary deals. And then just always being in their face, to use a simple expression, right? Always reminding them, because you have to do that. Again, it's they're all busy with what's more, with what's most important to them. So, but yeah, that's how. And being in the flow, right? You want to be in the flow of information. We want to have our ear to the ground about like what secondary transactions might be coming up. They come from a lot of different directions, right? So, we gotta have that all covered. But it's a lot of work.
I'm actually, like, as you're saying all this, I was like, oh wow, the last time we recorded, you were at 60 people. Like, a year and some change later, you're 10 more. Next time we record this, I don't know, maybe like a year from now, it's like 80 people. So it'll slowly appreciate over time.
Yeah, I don't know. We want to, we'll see. I mean, we need to digest everything we have. And we've added, what's great, we've added a new partner here in Israel. We're going to be adding here somebody soon for the first time to represent us in Europe. So super excited about all that. Yeah. There's going to be more people at Vintage for you to talk with in the future.
Oh, I love it. Yeah. There's the whole family. The family picnics must be quite vast.
Yeah. So,
as maybe my last question on secondaries, we talked a lot about what was it like back in 2003 and the beginning of Vintage. What's changed since then? One thing you mentioned is in the earlier days, you spent a lot more time focusing on M&As. Today, there are a lot more like IPOs versus M&As. Still a lot of M&As, but like a lot of IPOs as well.
Yeah.
Maybe not in 2025 so far. We'll see.
Yep.
But what else has changed since then?
Yeah, it's a great question. Again, for sure, it's like when we think about how we value the portfolios, where we're putting value and things like that. But really, when we started this, I remember going to companies and funds and talking about doing secondary directs, buying shares out of the companies. And they were like, A, can you do that? And B, why would I want you to do that? Right. So
Right.
it's amazing to see where the whole secondary direct market in particular has come. And there's just a lot more buyers and competition around that. I mean, there's just much, much more. Again, I think a lot of it is, companies stay private longer. You're seeing the exchanges get involved. I'm still of the opinion that you can't fully automate this. And, at least in maybe in the few major names, that don't want to go public quite yet. But even then, it's all very company controlled and things like that. But the secondary direct market has gotten much more mature and competitive. Which again, when that happens, also it's harder. You see a lot of silly stuff happening with people buying at prices that don't seem to make a lot of sense. And I think you saw that happen in 21 and 22. Everybody was running and buying shares in later stage companies on a secondary basis, and they're all marked down, between 50 and 60%. But there's definitely, it's a much more mature market in that sense. So I would say that's probably the biggest change. And the philosophy about selling shares in companies have changed. That it's not only possible, but in many cases it's a very good thing to motivate the founders, the employees, the management, to show that the shares in your company actually have real value, and it's not just on paper. That there's meaning to when somebody says, you got to refresh and options and what the price per share is. Again, it can go sideways in some cases, and there's been a bunch we've seen where the founders and the CEO have monetized maybe too much too soon. But in general, as a tool, I think it's a huge positive for the companies and the investors. It also takes, again, I think the main thing is it takes a lot of burden off the founders of the companies to really say, okay, I'm in this for the long term. And that was far from the case in 2003, probably all the way up until, at least 2010, where it was still kind of looked at like, what is this? Why are you doing this? And why should I do this? So less market education, which is nice.
It sounds like a lot more folks are, not everyone, but a lot more folks have a longer time horizon when they're thinking about this thing. And so that's good for relationships. That's good for partnerships. That's good for founders building companies.
Yep.
And yeah, I'm curious for you. There's a lot of companies, at least I'm looking in my own like underlying like portfolio of the funds, that when they send me the data, like there's so many companies that are going from like a mil to like 10 mil or like 0 to 5 mil in revenue, like within a year. And we used to think like the revenue number is the golden metric, but when everyone gets to it so quickly, and I actually think like Samir Kaji actually posted about this like a while back, which is like this annual curiosity revenue that a lot of these corporates have. How do you think about rewriting like the health of a company? Like how much has that rationale and that framework changed internally?
I mean, look, it's first of all, it's pretty incredible. Again, we haven't seen anything like this. At least I haven't in the past, whatever it is, 30 years. So you definitely need to give it more thought and kind of have a new lens on it. I think there's definitely, this is a new thing in the market that can continue, meaning that there's definitely going to be companies that are going to scale faster than ever before and are going to keep scaling faster than ever before. I think we all need to take a step back, and that's exactly it, and say, okay, does 5 million in revenue really mean the same as what it meant in terms of proving out, this is going to be a market leading, amazing company, versus what it was, even 3 years ago or 5 years ago or 10 years ago. So, I don't want to say it's easy to scale from, a few 100,000 to 5 million and then to 20 million. By no means is it. But I do think it's less meaningful than it was in the past. And that it goes more to the fact, okay, does this have the ingredients, you can judge it however you want, to really be the breakout market leader? Or is this going to be just something else that ramps and then it's 20, 50 or whatever the number is and just starts to plateau? So I think you got to be really careful. And the market is, particularly around things related to AI or cyber, and there is kind of a bubble going on because of that. And everybody kind of rushing to be there. So it's less, on the one hand, it's pretty incredible to see how fast things ramp. On the other hand, I think it's much less, I wouldn't put too much meaning on it in every case. I still think you got to do the nuts and bolts work as to, is this the team and the product and the investors and the market that's going to really rationalize, that 5 million is going to become $1 billion in sales at some point, right? Because that's, again, at least thinking as kind of an early stage investor, or if we want to put meaningful value on a company that ramps from 0 to 5, like it's more than just that ramp from 0 to 5.
And if I can add my own commentary there, I think there's obviously the quantitative metrics that you can look at. For example, sales efficiency, net revenue retention, like are your customers actually sticky?
Right.
But one of the things I have come to like in the last year or so, at least when I'm assessing founders, is like a lot of the good companies, they're scaling revenue pretty quickly and they all look good and they're all bragging about these numbers. But one thing I found to be really helpful is like the best founders often still have this level of paranoia.
Yep.
Where there's a lot of founders who are going to come to you and they're like, hey, you know what? We're doing good. Everyone wants our product. Market loves us. We're up and to the right. And they'll like, puff their chest out and be like, hey, this is what's going on. But the best founders often are like, things are really trending right in this direction. What are we missing here? Like there must be something. It's too good to be true. And that balance, I think, is really helpful when you're scaling an early stage business.
Yeah, I think you're absolutely right. I mean, one of the things that, Alan pounded into my head and we pound into everyone's head is kind of like, we talk about like product vision, maybe from 0 to 5, but we're always talking about, okay, you've done this with what you have now, but like, where does this go? I mean, it can't just be 9 times out of 10, this one thing. Like, are you already, and maybe that's the paranoia, what are you thinking about is next, to make, maybe what do you want to call it, the SAM, the TAM or whatever is a few $1 billion, but how do you make it 10 billion? And then how do you make that 50 billion? And how do you make it 100 billion, what have you? So I think some of that is connected to the paranoia, but for sure is kind of like, what's the next chapter here? To make it a better product, to make it more sticky, right? To get more usage out of it, what have you? Because at some point, all that stuff kind of runs its course. It's the rare company that on its first product gets it right, and that's what it's living on until today, right?
Oh my God, this has been incredible so far. So, Abe, I need you to help me land the plane here. I know you to be someone whose ambitions go far beyond the already incredible accomplishments you've already had to date, including co-creating the legendary institution that Vintage is today. But when you think about the final form of Abe Finkelstein and the body of work in which you leave behind, how do you want that sculpture to take shape?
Well, that's a pretty heavy question. I think
it's gonna be my last question for you.
I don't know. Like there's a lot more to do. There's a lot more to do here. That's for sure. I mean, look, on a personal basis, I just hope that people would. I think of myself associated. Obviously, it's almost like I am Vintage and Vintage is me. But hopefully, people will have. Like being part of the Vintage family and working with Vintage, and that Vintage can carry on, forever. I don't know what my final form is going to be, but again, I do hope that people just would say, hey, Vintage is a great group to work with. They're honest, they're humble, they know how to hopefully make people money, but. My final form, I'm not sure. I got a few more years to get to the final form. I'd love to hear a great answer to that question. So I'm gonna have to do some. I'll have to do some work on that.
I mean, great is relative as long as it's meaningful and impactful to you.
Yeah. I mean, look, I want to. I always say I hope we're like I said, building a long, everlasting firm at. Vintage, and I'm hopeful that I'm going to be around to see it as long as I can.
I love it. I love it. You will be here for a very long time. I will come to you with many more questions.
Yes.
Vintage will slowly grow over time. You're going to have a head of LATAM at some point. You're going to have a head of Southeast Asia. I don't know. Right. But like, these are my words, not your words, by the way. So like for all your LPs, I'm throwing shit at like, Abe right now.
Like you said, you're hired. You're going to help.
Thank you. When's the offer? Abe, thank you so much. This has been absolutely incredible. I was really looking forward to this conversation since our last one. And the one part we didn't get to touch on in our last conversation was the secondaries piece. Yep. And now my heart feels full again.
Great. Fantastic. No, I'm glad we got to do it. I'm looking forward to the next one.
Amazing. Well, until the next one, Superclusters fans, we'll see you soon. Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 3 small things. 1, there's a little red subscribe button down there on YouTube and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click and you'll get many more presents, insights, and brilliant minds straight through the internet vines, just like this one very, very soon. 2, let me know down in the comments what your favorite Abe mic drop moment was in this episode. Mine was simply the fact that if you're investing in junk, even if you get a discount on junk, it's still junk. So 3, it'd mean a lot to me if you could share it with one other friend that you could gain a lot from listening from today's cosmos of insights. And also let me know if there's something I should have asked down in the comments. And if there's enough interest, we'll bring back today's guest for an even spicier part 3. I know a lot of you did ask for Abe to be on part 2. And so voila, we have today. And so if you want more of Abe, let me know. I made a promise to myself to record 100 episodes of Superclusters. So every comment, question, and review helps me make this experience a lot more meaningful and helpful to you, and makes investing in venture a little less scary and a lot more friendly. Lastly, I want to share a quick disclaimer. The views expressed in this podcast are for informational and educational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization we're part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusion or references to funds or companies are for illustrative purposes only and should not be relied upon for investment recommendations. Consult a professional investment advisor before making any investment decisions. And that's all from me. See you on the next.